Your emergency fund can lose $3,000 at exactly the moment you need it most. Put $15,000 in stocks, watch the market drop 20%. Suddenly, the cash you thought you had is only worth $12,000. If you have to sell, that $3,000 decline becomes a real loss. That's the problem with treating emergency cash like investment money. They might sit in the same app, they both look like dollars on a screen, but they have completely different jobs. Your investment portfolio is supposed to grow over years and ride out the swings. Your emergency fund is supposed to pay the rent next Friday, cover a deductible tonight, or keep groceries in the house after a job loss. If the money has to wait for the market to recover before you can safely use it, it's not doing the job of an emergency fund. You've probably heard that cash shouldn't sit idle. That advice sounds smart because cash can lose purchasing power to inflation, and long-term investments have historically offered more growth. But the advice becomes dangerous when you apply it to money you might need next week. Emergencies don't check whether the market is up. A broken transmission doesn't wait for your portfolio to recover. Your landlord doesn't accept the index fund is down, so the rent needs another 6 months. There's another trap hiding inside the word cash. A savings account, a money market deposit account, a brokerage cash sweep, and a money market mutual fund can all look stable. Their names sound almost the same. They're not. Their insurance, access rules, and risks are different, and those differences matter most when you're already under pressure. An emergency fund has 3 goals: safety, access, and yield. Most people try to maximize all 3 at the same time. You can't. The more aggressively you chase return, the more likely you are to accept price movement, waiting periods, or transfer friction. That doesn't make the higher return product bad. It just means you need to decide which job matters most for each dollar. For emergency money, safety means the amount should not suddenly be 20% lower when the bill arrives. Access means you can move the money fast enough for the kind of emergency you're protecting against. Yield means the money earns something while it waits. Yield matters, but it comes third. That order isn't exciting. It's useful. The primary job of an investment portfolio is long-term wealth building. Its time horizon may be 10, 20, or 30 years. Volatility is expected. A market decline can be uncomfortable, but a long-term investor may have time to keep contributing and wait. The primary job of an emergency fund is to preserve spending power for a near-term problem. Its time horizon may be today, next week, or the next few months. Volatility is not a feature you want because the money may be needed before any recovery happens. The same market drop can therefore mean 2 different things. In a retirement account you won't touch for 20 years, a decline may just be temporary noise. In an emergency account needed after a layoff, the same decline can force a sale. That forced sale is what changes the math. Take the $15,000 example. Imagine all of it is invested in a stock index fund because you don't want the money sitting in cash. The market falls 20%. The account is now worth $12,000. Then your employer cuts your position and you need the entire emergency reserve for housing, insurance, food, and debt payments. Selling at 12,000 locks in the 3,000 decline, you didn't lose 3,000 because stocks are bad. You lost control because money with a short deadline was placed in an asset with a long recovery window. Suppose you were comparing an illustrative 7% return in stocks with a 4% yield on cash. Neither number is guaranteed, and actual rates and returns will change. On 15,000, 7% would be about 1,050 for a year. 4% would be 600. The difference is 450 before taxes. You accepted the possibility of a 3,000 forced sale loss to chase an extra 450 in that example. The upside difference is measured in hundreds. The timing risk is measured in thousands. That doesn't mean every emergency dollar must sit in a checking account earning almost nothing. It means the fund should be built in layers. The first layer handles speed. The next layer handles stable access and some yield. A final layer may accept limited weighting, but only if the earlier layers are large enough to protect it. For the immediate layer, think about money that may be needed within 24 hours. This could be in a checking account, a linked savings account, or another appropriately insured bank or credit union deposit account with reliable access. The exact product matters less than the real-world test. Can you move the money on a weekend? Is there an ATM or debit option if needed? Are there transfer limits, minimum balances, fees, or holds? Is the institution insured? And is your balance within the applicable coverage rules? That does not mean the entire fund belongs in checking. The same access that makes checking useful also makes the money easier to spend by accident. If emergency cash is mixed with rent, groceries, subscriptions, and weekend spending, the line between an emergency reserve and an available balance starts to disappear. Keep the first layer large enough to handle an urgent problem, but separate the rest so it is less likely to be spent on normal life. At an FDIC-insured bank, Eligible deposit accounts generally receive coverage up to $250,000 per depositor per insured bank for each ownership category. Checking accounts, savings accounts, and money market deposit accounts can be covered. But that does not mean every separate account receives its own $250,000 of coverage. The FDIC combines deposits held in the same ownership category at the same insured bank when it calculates the limit. Stocks, bonds, and mutual funds are not FDIC-insured deposits. The words in the product name are not enough. You need to know what the product actually is, where the money is held, and how all of your deposits at that bank are titled. A high-yield savings account is useful for emergency reserves because the balance is designed to stay stable, the money is generally accessible, and the account can pay more interest than a basic savings account. But high yield does not mean fixed yield. The annual percentage yield can change. A bank can raise it or lower it as market conditions and its pricing strategy change. So choose a high-yield savings account for its role, not because you believe today's rate will last forever. Also check the details that advertisements tend to hide. How long do outgoing transfers take? Does the bank limit transfer amounts? Is there a minimum balance for the advertised rate? Are there monthly fees? Is the bank itself FDIC insured? Or is a financial technology company placing deposits at partner banks? A high number on a comparison page is not the same as verified insurance and dependable access. Now the money market name problem. A money market deposit account is a bank deposit product. If it is held at an FDIC-insured bank and your deposits fall within the insurance rules, it can receive FDIC coverage. At a federally insured credit union, qualifying share accounts are covered under the separate NCUA system, subject to its rules and limits. A money market mutual fund is different. It is an investment fund that typically holds short-term debt instruments and cash equivalents. It may be relatively conservative compared with stock funds, but it is not an FDIC-insured bank deposit. Its value can move, and investors can lose money. The fact that both products use the words money market does not make them interchangeable. You may think moving $7,000 from an insured savings account into a money market fund is just an account upgrade with a better yield. It is actually a product change. You may have moved from a deposit with bank failure insurance to an investment without FDIC coverage. The balance may still look calm, but the protection underneath it is different. Similar label, different legal structure, different risk. Brokerage cash sweeps create another layer of confusion. Uninvested cash may be swept into a bank deposit program or into a money market fund. A bank sweep may be eligible for FDIC insurance through participating banks, subject to limits and program details. A money market fund sweep is an investment, not an FDIC-insured deposit. Do not assume that the word cash on a brokerage screen tells you which one you own. Open the disclosure and verify the destination. One more distinction matters here. A money market fund held at a SIPC member brokerage may be protected as a security if the brokerage fails, subject to SIPC rules and limits. But SIPC does not protect you from a decline in the value of the investment, and it does not guarantee that the fund will maintain a stable price. FDIC insurance and SIPC protection solve different problems, so they should never be treated as interchangeable. Treasury bills can fit into an emergency system, but not as the first dollar you may need tonight. T-bills are short-term US Treasury securities with maturities ranging from 4 weeks to 52 weeks. They are typically sold at a discount or at face value, and at maturity, you receive the face value. They are marketable, so they can be sold before maturity, but selling early is not the same as withdrawing from savings. If you sell a Treasury security before maturity, the market price may be higher or lower than what you paid. You also have to consider where it is held and how the sale works. Through a bank or broker, you contact that institution. In Treasury Direct, selling before maturity requires transferring the security to a bank, broker, or dealer, and Treasury Direct applies a 45-day holding period before a marketable security can be transferred or sold. That means a 4-week bill bought in Treasury Direct is not something you can sell before it matures. This is why T-bills can be a second-layer tool, not a perfect substitute for instant cash. Now build the $15,000 fund in layers. Put $3,000 in the immediate access layer. This is the money for the first few days or the first urgent bill. Put $7,000 in a high-yield savings account or another appropriately insured liquid deposit account. This is the stable middle layer that can cover the next part of the emergency while still earning a variable yield. Put the remaining $5,000 in short-term Treasury bills, only if your first two layers are large enough that you can wait for maturity or handle the steps required for an early sale. $3,000 plus $7,000 plus $5,000 equals the same $15,000. The difference is not the total. The difference is what each dollar is ready to do. Some people look at the $3,000 immediate layer and call it lazy money. But That $3,000 may be the hardest working part of the system. It can pay the deductible, buy groceries, and cover the first rent payment without forcing you to touch the other $12,000. The layer with the lowest yield may be the layer that protects every higher yielding dollar behind it. The layered fund does not maximize the return on all $15,000. That is the point. It maximizes your ability to avoid a bad decision under pressure. If the first $3,000 buys enough time for a paycheck, insurance payment, severance package, or maturing T-bill to arrive, the lower yield layer may prevent the liquidation of thousands of dollars at the worst possible moment. How should you build your own version? First, calculate your essential monthly expenses. Do not use your full lifestyle budget. Focus on housing, basic food, utilities, insurance, transportation, minimum debt payments, medication, and other costs that cannot be paused. If those essentials total $4,000 a month, a 3-month reserve would be $12,000 and a 6-month reserve would be $24,000. The correct target depends on job stability, household income, dependents, health needs, and how quickly you could reduce spending. Second, decide how much must be available immediately. Ask what could realistically happen before a normal bank transfer clears or before a security matures. A homeowner with a high insurance deductible may need a larger first layer than a renter with low fixed costs. A single-income household may need more instant access than a dual-income household with stable jobs. Third, place the next layer in an appropriately insured liquid account. Verify the institution, the account type, the insurance status, the transfer process, and any limits. Do not stop at the advertised yield. Ask how the account behaves when you actually need the money. Fourth, consider short-term Treasury bills only for the portion that can wait. Match maturity dates to the amount of cash already available. You might create a small ladder so that bills mature at different times, but do not build a complicated system that leaves you short before the next maturity. Complexity is not a substitute for liquidity. Fifth, keep long-term investments separate. Your retirement account, taxable brokerage account, and emergency reserve may all be part of your financial life, but they should not be assigned the same deadline. Money that can remain invested through a long downturn belongs in the investment bucket. Money needed to protect next month's bills belongs in the emergency bucket. Sixth, review the system when your life changes. A new child, a home purchase, a move, variable income, a health issue, or a less stable job can change the size of the immediate layer. Interest rates can change the relative appeal of savings accounts and treasury bills, but rate changes do not erase the need for access. Consider Maya. She earns $72,000 a year and spends $4,200 a month on essentials. She has a $15,000 emergency fund, but she invested all of it in stocks. The market falls 20%, reducing the account to $12,000. And then she loses her job. During the first month, she needs $4,200 for normal essentials, plus a $1,500 health insurance payment and medical expense. She cannot wait for a market recovery. She sells. The $3,000 decline is no longer theoretical. Now imagine Maya had used the layered system. Her $3,000 immediate cash covers the most urgent bills. Her $7,000 insured savings layer covers the rest of the first month and part of the second. Her $5,000 treasury layer can mature or be handled with more time. She may still face a stressful job search, but she is not forced to make every financial decision on the market schedule. Daniel has a different situation. He is single, earns $95,000, has stable government employment, and spends $3,500 a month on essentials. He keeps $5,000 immediately accessible and another $9,000 in an insured savings account. Because those layers cover 4 months of essential spending, he is comfortable placing part of a larger reserve into short-term treasury bills. For Daniel, the treasury layer works because it sits behind enough cash. The product did not become more liquid. His system made the waiting period manageable. Chris and Elena have 2 children, 1 primary income, and $6,800 in essential monthly expenses. Their risk is not just one bill. A job disruption could arrive with childcare costs, medical expenses, and a home repair at the same time. They choose a much larger instant access layer than Daniel. That may lower the average yield on their emergency fund, but it fits their actual exposure. Copying Daniel's allocation would be mathematically neat and personally wrong. These examples point to 3 questions. How quickly might you need the money? Can you tolerate a withdrawal, delay, maturity date, transfer requirement, or early sale price movement? Do you specifically need FDIC or NCUA deposit insurance for this portion? Your answers determine the product. The product should not determine your story after you have already opened it. There is one more cost people ignore: the cost of being forced into debt. Imagine a $2,000 emergency while your money is temporarily inaccessible or down in value. If you put that expense on a credit card at a high interest rate and take months to pay it off, The attempt to earn a little more yield can create interest charges and stress that overwhelm the extra return. Liquidity has value even when it does not appear as a line called earnings. Cash still has trade-offs. Inflation can reduce purchasing power, a savings rate can fall. Holding too much in the immediate layer can create a real opportunity cost over many years. None of that changes the core rule. You solve those trade-offs by sizing and layering the emergency fund, not by pretending short-term money has a long-term horizon. Your emergency fund is not an underperforming investment portfolio. It is a personal liquidity system. Its job is to protect your housing, your food, your insurance, your choices, and even your investment portfolio from being sold at the wrong time. The return is not only the interest deposited each month, part of the return is the $3,000 loss you did not have to lock in. Part of the return is the credit card balance you did not create. Part of the return is the time you bought to make a calm decision. Do 3 things today. Identify the amount that must be available within 24 hours. Verify the exact account type and deposit insurance status of every place you call cash. Then draw a hard line between your emergency allocation and your long-term investment allocation. Once the money is in the right places, the next question is whether you are holding the right amount. 3 months of expenses may be more than one person needs and dangerously low for another. The calculation changes when you have one income, variable pay, dependents, high deductibles, or a job that could take months to replace. That is where the real emergency fund math starts.